Good morning, and thanks for joining us here on Treasure Coast Solutions every Wednesday from 9 to 10 o'clock. We talk about some of the issues that may affect you in your daily lives, some of the things that may be on the horizon, kind of from a financial standpoint and an economic standpoint. We're not a financial planning show, so I'm not going to help you retire in comfort and ease, but I will hopefully give you some things to think about. Like I said, we try to talk a little bit about the economic side of what's happening in the economy and in finance and things to be aware of. I wanted to kind of get into that. My name is Mark Breckbill. I'm a CPA. I'm a retired banker, ex-banker, and and I have a CPA firm that I've had for 25 years now. So I've been dealing in the finance and sorry, COVID got me. I was been dealing in the finance and economic world for some period of time, and it's an interesting place to be. In fact, in the years that I was a banker, I think I was a banker for about 13, 14 years. And I used to start banks, which was kind of interesting. But in those days, it was interesting because you were a part of most of the cutting edge finance issues and the economic issues, and economic forecast, financial issues, economic indicators and things were all key to what we were doing in that industry. And a lot of times we, especially in my role as chief operating officer or chief financial officer over those years, my role was largely to try to determine what was going to happen and position the bank for some benefit there, and position us for to be in a situation where we wouldn't get hurt based on what happened to the economy and what happened to interest rates. So it's kind of interesting in my world as a CPA. I do a lot of that. A lot of consulting work, a lot of asset protection work, which is kind of the downside or backside of what happens if you don't predict correctly or don't position yourself correctly. And that happens. I mean, that's part of what's going on. It's all a guess. If anybody tells you they have an answer, they don't. If they did, they would be multi-billionaires and wouldn't be working and wouldn't be giving other people advice, frankly. But you never know. You never know the exact answer. It's kind of interesting. When I used to, without getting too much into it, one of my jobs was to determine what the bank's exposure was to changes in interest rates, up or down. And a lot of people think that banks want interest rates to go up because they make more money, and generally that's not the case. It depends on how the bank is positioned. So the big banks, they have a lot of, they would have tend to in those days have a lot of short-term loans, and so they could adjust their rate frequently. So if the rate went up or the rate went down, they could adjust the rate. And so what was important for them was what was called the spread, and that's the difference between the rate that they could charge and the rate that they were paying for their money. And the other thing that was a factor, and this was the big factor, kind of put the savings loan industry out of business, was what they called the gap. And that the gap analysis, and that's not gap as in generally accepted accounting principles as an accountant, but that's gap as in the exposure that a bank has relative to interest rates. Whether, for example, if they have a lot of fixed rate loans and a lot of adjustable rate deposits, and interest rates go up, they can't adjust the loan rates because that rate is fixed, and the deposit cost goes up, they make less money. So there's a situation in a rising interest rate where if they're positioned in that manner, they're going to lose money. And then the other way around is if you've got a lot of adjustable rate loans that they're tied to prime or in the old days LIBOR or whatever, that would change more frequently, and you had fixed rate deposits, you had gone out and borrowed 90-day or 6-month money, you actually then made money when interest rates went up. But the key was how you were positioned. And you positioned yourself based on what your market allowed you to do. The small banks, the community banks, didn't have access to the large funds markets that, especially the long-term deposit markets that the big money center banks had. And they didn't have access to the floating rate loans, the variable rate loans. Many times the loans that small banks had to deal with were consumer loans, like car loans that are typically fixed, and mortgage loans that were typically fixed, and things like that. So how the bank was positioned made a big difference. The money center banks usually made money when interest rates went up because they were positioned with loans that changed rate more frequently than their cost of their deposits. Community banks were affected going the other way because they had a lot of fixed rate loans. So if interest rates went down and their deposit costs went down, they made more money. But nowadays banks can adjust for that. They can use things like futures and options to hedge their positions and do things to mitigate or actually take a position that they think that is going to happen. So they can cover themselves. So if they think that interest rates are going to go up, they're going to convert their fixed rate loans into variable rate loans, or possibly focus more on fee-based income, things like that. And so they can make an adjustment. And many times they use that by using their investment portfolio to offset it. And it gets kind of technical, but it's interesting because it's different than what people think. But it is important to understand because banks have a couple different kinds of risk. One is the risk we were just talking about. It's what's called interest rate risk. That's the risk that you've taken the wrong position and can't get out of it fast enough, and you're then not making a big enough margin or spread to cover your costs, your overhead costs. So overall, that's called interest rate risk. They also have something along the same lines called liquidity risk. That's the situation where if they had to pay out on their deposits, and they can't collect fast enough on their loans, on the principal of their loans. So let's say that that they're a $1 billion bank and they got $700 million in loans, and they got somewhere similar to that in deposits. If all of those deposits pulled their money out, if $500 million, let's say, pulls out, there's no way you can go to that $700 million worth of loans and say, I need you to pay me right now, because they're probably not demand loans. They probably have some term. So that's liquidity risk. That's the risk. And that's actually what happens. That frankly is the only risk that can force a bank under, is liquidity risk. The fact that their inability to get money. And so when a bank goes under, it's interesting. Banks don't go bankrupt, and banks can lose money forever as long as their depositors don't pull the money out. So what used to happen in the old days when the savings and loan industry was having a problem and everything else is, even though the savings and loans were losing money hand over fist because they had these long-term 30-year loans and their deposits were 6 months and rolling over 6 months, and their interest rates were going up, and eventually their interest rates on their deposits were in excess of the mortgage rate, and they were consistently losing money, right? But they didn't go broke by consistently losing money, because in those days people had their passbook savings account. Nobody was going to get their money out. They didn't go to get their money out until the government said, we think you're going to fail. And as soon as the depositors found out that the government said, we think you're going to fail, they went and took all their money out, and lo and behold, the government was right. And the government is right on a lot of things because they create the situation that they're saying. It's they tell you you're going to fail. Well, if you tell your depositors that, they will pull all their money out, and the only way a bank can fail is liquidity, is they can't cover the deposits when people want their money, and it's called a run on the bank. And that's what they do. The regulators created runs on the bank. And so in the 80s, the savings and loan industry went away because the regulators created a run on the bank on the savings and loans before they could adjust their position to get out of their their liquidity risk. So that risk. But like I said, that's the risk that actually can cause you to go under, is liquidity risk. And so what happens is there's a third type of risk, and it's called credit risk. That's the risk that a loan will default, that the borrower won't be able to pay back the money. And that's a significant risk. That's actually the risk that banks get paid for, believe it or not. All this other stuff is risks that banks take because of the industry that they're in. But credit risk is the risk that they have to take to make money. In other words, if a bank doesn't take risk when they loan money to someone, then they're going, if they choose to and instead take a riskless investment, like a bond, a treasury bond or something like that, then they don't make any money because there's no spread on that. In other words, that cost is virtually the same as their cost. And so therefore there's no money. So they don't make any spread. They can't cover their overhead. And ultimately they go out of business if that stays very long because they run out of liquidity. Depositors don't keep putting money in. Now, if the depositors keep putting money in, nobody cares what happens on that credit risk. And so credit risk is what banks get paid for. And evaluating that risk, the bigger the risk that they take, the bigger the reward. So the downside is that if they make a mistake, the government comes in and says, you're going to fail. We are going to put restrictions on you because we think you're going to fail and we don't want to have to pay out on the deposit insurance. So therefore, we're going to put you under a memorandum of understanding. We're going to put some restrictions on you. You can't do business. You can't make these kind of loans. You can't do these kind of things. Now, the government did that in the last recession. They did that to the community banks. That's why many community banks are gone, and that's why we don't have community banks as competitors. Those they did that. What happened was by doing that, they basically forced these companies out. They forced the banks couldn't get credit risk. The government put these community banks out of business. So the community businesses, the small mom and pops, the Main Street businesses, they couldn't get capital. But what they did is at the same time, they said to the large money center banks, the Bank of Americas, the Citibanks, the Chase, the TD Bank, you name them, the big banks, that's what we're talking about. They basically said to them, no, you're too big to fail. We will not let you fail. All right. Now, the reason that's significant is because we were just talking about three kinds of risks, and there's only one risk that causes a bank to go under, and that's liquidity risk. It's not credit risk where you lose money because you made a bad loan. It's not interest rate risk because you took the wrong position and you lose capital because you could lose money because your costs are in excess of your income. Neither one of those cause a bank to go broke. It is what? Liquidity risk. So when the government says to a big bank, you're too big to fail, what they're saying is you no longer have liquidity risk. So now, if I no longer have liquidity risk, but I still have to make my money off of credit risk or to some degree interest rate risk, I can either bet my bank on interest rates. I can position myself thinking interest rates are going to go way up or way down, and I'm going to position myself to take advantage of that. And if they go the other way, I'm going to lose a ton of money. Okay. But what's happened? Government says, I don't care if you lose a ton of money. We will give you more money. We will bail you out. We will give you deposits. If your depositors leave, we will replace your depositors with our money. We will put the full faith and credit of the U.S. government behind you. We will back you. We will increase your deposit insurance. We will do whatever's necessary to make sure you don't fail. We will actually loan you money directly from the Federal Reserve. We make you a discount loan, it's called, and they will actually make you a loan directly, which is supposedly only available for banks that are going to fail. But they say you're too big to fail, so we will provide those resources. All right, so I'm the banker now, and my job is to make money, and I make more money the more risk that I take that's successful, right? But for me to make more money and hit that successful, I have to take a risk that could be very, very unsuccessful, which could cost me to go broke from an income standpoint. It could cause me to go broke. But what happened? Government said you can't go broke. You can go broke, but we're going to provide you with money so you don't go out of business, so that even if you have a run on your bank, we will support you. Well, if I'm a banker at that point, what am I going to do? I'm going to do whatever makes me the most money. And whatever turns out to be the best deal for me. And that means I'm going to potentially take a larger credit risk, but I'm not necessarily going to take it at the Main Street level. I may take it by investing my money in foreign countries. I might invest in currency. I might invest in businesses that are based in Europe or based in China. So I'm going to shift my money from the domestic front to developing countries where I make a lot more money. Now, I can lose a lot more money, but I can make a lot more money. I'm going to shift my money to big corporations, because big corporations have a tendency to borrow big amounts of money. They have access to markets that banks have access to. But from time to time, they need large amounts of money from the bank, and I'm going to be there to loan them the money, because you know what? The government's probably going to bail them out. Look at General Motors. If I was a banker, I'd be lending money to General Motors and probably Ford now to beat the band, because the previous administration, the Obama administration, had basically said General Motors was too big to fail. We're not going to let it fail. Too many jobs will be lost. That's not true. Those jobs are the amount of jobs that a major corporation generates is minuscule compared to the multitude of jobs that are created in Main Street. And what happened is they pulled resources away from those banks and they pumped it in to the major corporations and saved Wall Street. But in the process, they damaged Main Street tremendously. And we've seen that happen. And that's why right now we have a very difficult situation coming forward, because we have borrowed billions and trillions of dollars worth of debt. I mean, our debt is our gross debt is, they talk about the deficit, the annual deficit. We've got an annual deficit probably of $1 billion or whatever the number is, almost $1 trillion, or 100 billion, 200 billion, or whatever the number is. That's just the annual deficit. That's just how much we're borrowing on our credit cards this year. That doesn't mean that's not the total amount of money that we owe. We borrowed money a long time ago and consistently to fund our Social Security, our Medicare, to fund our government programs, to fund our military, to fund whatever. We've borrowed and borrowed. We've borrowed for infrastructure. Everybody says borrow for infrastructure. That money's not the same thing. It's borrowing. When it doesn't become debt, then you can tell me it's not the same thing. But as long as we're borrowing trillions of dollars, it's going to have an impact. It's going to have an impact because it's going to impact what banks do. And the banks and some large Wall Street corporations are the fallacy of the last recession. In other words, we had what was the Great Recession. And frankly, that was the worst thing that could ever have happened to us. We should have had another Great Depression, because the only difference really would have been the banks would have gone out of business. It would have caused great disruption, but then things would have re-equalized. We would have never gone as far into debt as we are right now, because we've kind of bled ourselves to death financially over the last 8 years, 12 years. And so at this point, and I'm including the Trump administration, we borrowed a lot of money under all of these. And you can argue that there's good reasons for all of it, But from an economic standpoint, it is debt, and it has to be repaid, unless you're a Keynesian who thinks that it never has to be repaid. And that's what I kind of wanted to get into a little bit. And if you've got a comment, feel free to call 220-9788, 220-WSTU. That's the number in the studio. Write that number down for future uses and other shows. It's a good number to have in case you need to call in and get some information. But the reason I wanted to get into this today is this is what we're looking at, and I'm going to ignore all the stuff that's going on, and I don't care who ultimately what the outcome of the election is, because frankly, whoever is president is going to have to deal with this, and they can either just make it worse, or they can try to make it better. But if they try to make it better, it's going to end up in a very difficult place no matter what. And that is because for a capitalistic system is driven by investment. Investment comes from two sources. For Wall Street, it comes from the sale of stock, the sale of new stock, the sale of bonds, the sale of preferred stock. All of that over the public market, all of that generates investment money for companies. That's how they can get their investment capital. And then they can turn around and use that to buy stuff. They actually, if they've got cash reserves, they can use their own cash to buy back their stock. And that uses their investment. And so that produces a higher return for their stockholders, because there's fewer stockholders. So Wall Street has a lot of alternatives in terms of ways to produce a higher return to their investors. But ultimately, that's how they do it. Is they borrow through stock sales or through debt or preferred stock. Now, Main Street, that's a different story. Their only choice is borrowing from banks. Usually, that's local banks, and then other than that, they don't have a lot of. They can use internal capital, but internal capital is expensive. I mean, that's money where, on paper, the owner of the company has made the money, they've paid taxes on it, but there's not enough cash available for them to pull that money out, because they have to leave that money back in their business to cover their inventory, to cover their next payroll, to cover whatever, because their business is growing and has a certain level of cash needs that they have to cover. The bigger the small company is, and frankly, the longer it's been around, the bigger that number is. One of the problems that we had with the Great Recession is that it extracted a tremendous amount of capital out of the small business market. So what had happened is, and this is why many small businesses that have been around for a long time, managed to survive, and actually in the early stages of the recession, did better. And the reason was that many of those businesses over a period of 20 or 30 years had, hundreds of thousands or millions of dollars in capital that they had paid taxes on. It was their money, but they had left it in the business to finance growth. So instead of borrowing from the bank, they borrowed from themselves, in effect, and they bought their building, or added a new truck, or added a new shift on the line, or whatever. That's how they funded it. They funded it out of their pocket. Now, many of them didn't really realize it, because it happened over a long period of time. They didn't realize that they had built up that much equity. But that's in effect what had happened. And so when business stopped, what you had was a situation where you were still collecting money from your receivables and from inventory that you had produced that you were selling. You were still collecting some of that, but you didn't have costs anymore because you had shut down part of your operations, you'd laid off people. And so what was actually happening is you were catching back up. You were actually getting some of your capital back because now you didn't have to fund receivables and you didn't have to fund next week's payroll or whatever because there wasn't a payroll. There wasn't any receivables. They were all being collected. So, or written off, but hopefully most of them were being collected, and that generated and pulled that capital out. Now, what's happened, and this is what has been, what has happened with the last 4 years is that the Trump administration really, through borrowings and taxes, in effect, especially with small business, kind of pushed some capital back in. They kind of encouraged the banks to loan money. They took some of the regulations off banks. They didn't tell them that they were not too big to fail, but they did take some of the regulations off of them. And so as a result, more money went down into small business. That was significant because there was no internal capital left. Many times these businesses had used up 20 or 30 years worth of internal capital and they had none left. And that's why they were starting. And many of the smaller businesses that hadn't been around that long and hadn't built that kind of internal capital, they went under. So now what's happened, though, is that we pushed some capital back down there. The banks had to do something with their money. The economy was going. They had to do something with their money. Europe wasn't an option. The deposit growth was starting to occur at the individual level. The housing market started to come back, and they had to do something with their cash. And the banks don't loan money out long term in the housing market. They sell those loans because of the interest rate risk. They don't want to take the risk that they have a 30-year loan that's a fixed rate and it's not going to be paid back for an average of 12 years. And yet they've got deposit money. They don't have any 30-year deposit money. They don't have any 15-year deposit money in general. Some of the money center banks have the ability to get that kind of money, but the small community banks don't. So they generally sell those loans. They have to sell those loans out. So the housing market came back, but that's now a government-funded market. The Fannie Mae and Freddie Mac, Ginnie Mae, FHA, they fund that market, and it is exclusively a government-controlled market. So the housing market is sucking up capital, but that capital is coming directly from the government in the form of guarantees. So and then the cash, the liquidity is there because the banks are able to just turn that money and they get their cash right back because they sell those loans out to somebody who puts them into bonds, and then some investor, some retirement portfolio somewhere buys those bonds as part of a mutual fund, and that's what happens. So what happens is small business, some of that money started to trickle back, but generally it was coming through the SBA. So what was happening the last 4 years is we had a good economy because there was money available, but that money available was still coming from the U.S. government. It was coming in the form of SBA loans. It was coming in the form of small bank loans that the banks were kind of encouraged to make. There wasn't a lot of long-term money coming. There was no permanent money that was really coming. Real estate money was coming from the private sector. It was not coming from the banks in general. They were not willing to take that kind of risk. Why? Well, they got burned during the last recession on real estate, and bankers are just like little kids, because I was one. They're just like little kids. They learn only by their mistakes. And so if it happens, and they learn from it. But if you protect them from it, they never learn because you tell them. So if you tell them, don't do this because you're going to risk a lot, and if this happens, you're going to have trouble. Well, it's like, don't put your hand on the stove, you're going to burn yourself. Well, how many times has a parent told their kids that? 4 or 5 times, typically boys, because we're stupid. How many times they said 4 or 5 times, don't touch the stove? When does the kid figure out not to touch the stove? When they touch the stove, right? They never touch it again. They touch it at 4. They never touch it again, even when they're maybe 40. Why? Because they learned their lesson the hard way. We all know, that's what we were told. You're going to learn your lesson the hard way. Well, bankers have to learn their lesson the hard way too, and we protected them from that. They do not learn their lesson the hard way now. They're only going to be told, and we've told them you're gonna have problems, but you know what? We're not going to penalize you if you do, but we'll just tell you, you still get the cookie that's on the stove. So, but anyway, and that's what's kind of happened. So what we're looking at now is that the recovery, which was a tremendous recovery that we've had the last 4 years, it was a recovery still that was largely funded by the federal government, not just in deficits, but in financing and cash flow that was encouraged to flow down to the lower levels. Tariffs protected some of the small farmers and small businesses, but in general, all of this stuff, I hate to say it, was trickled down. In other words, they protected some of these larger Main Street businesses, and that all spread quickly through to the smaller Main Street business, mainly by providing them with funding, largely through the SBA. So that money was there, but we were rapidly running into a situation where the government was going to run out of money. You say, well, how does that happen? Well, the government doesn't make anything, produce anything, so they don't generate capital of their own. They just, they can tax you, but the bottom line is the government's money is really all of our money. And here's where the argument comes, and it's been proven time and time and time again. But again, I think Keynesian economists are all bankers. They're the same guys that have to touch the stove, and they have to touch it multiple times. So unlike the 4-year-old that touched the stove and burnt themselves when they're trying to get the cookie, Keynesian economists are like the 4-year-old that continues to burn themselves at 6 and burn themselves at 10 years old and 20, and now at 60 they're burning themselves, and because they never learned the lesson, because they think that this time when they touch that hot stove they won't get burnt. And that is actually, I'm going to say, that is the basis of Keynesian economics. It's based on the philosophy and the theory that the government can spend an unlimited amount of money because it can borrow an unlimited amount of money and not have an impact on anything. Now, you and I both know that that's not possible. I mean, we don't have to be economists to understand that there is nobody that can borrow money indefinitely in whatever amount they want without having an impact on something else, right? So if the federal government is out there borrowing tons of money to help business or to help whoever and the individual, and they're borrowing tons of money for this, right? That means somebody isn't going to have access to that borrowing, because whoever's lending that money is going to lend it to the federal government because they're potentially a better risk until they aren't. They are a better risk than the small business on Main Street. So who's going to suffer? The small business on Main Street. So even if the government does things with money that's designed to help small business, they're in a roundabout way taking the money away from small business in the process, because they are shutting off their access to capital. And so that is the difference. And frankly, that is why communism and socialism doesn't work, because of the fact that to fund it, you have to borrow money, because there's no incentive for people to earn income, because they get paid whether they work or not. They get benefits whether they work or not. They get benefits whether they need it or not. So the net effect is that in those kind of systems, the government is a spender. They are, and I don't care how good you think the cause is, if the government is spending more money than the economy is making, which is what's happening in that situation, the government has to borrow that money from someplace. Well, it's probably not borrowing it from its own domestic parties, because they're needing the money. So where are they borrowing it from? Well, in the past, we borrowed a whole heck of a lot from China. And at that point, do we become part of the Chinese government? I think you probably do. I mean, if if the major investor in the U.S. economy is not Main Street or Wall Street, even through taxes or whatever else, if that's not the main investor in the economy, but rather the main investor in the economy is the government that the economy that our government is borrowing money from, i.e., China or maybe Russia, but in this case, Russia is worse than anybody else. Is most likely China. If we're borrowing tons of money from China, uh, then how do we avoid coming under their control? If they can cut us off, and at that point we all starve to death, I think they pretty much have us. They don't have to actually come and take us over. They don't have to send any military. They don't have to do anything. All they have to do is cut off that financial stream. And that's what we're looking at. Now, the bottom line that we're talking about is, like I said, the Keynesian believes that you can borrow an unlimited amount of money. And they have been in power every single time that we have had large socialist reform. Roosevelt, Johnson, all of those times, they've been in charge until it all collapsed, or until we had a war. Thank God, a war saves us from a lot of stuff, but I don't think most of us want that. But anyway, the bottom line, though, is that there is not an unlimited supply of money, and we're seeing this right now. And I'll give you a real interesting tale or story of what's happening. So we had all this stimulus money, and we needed the stimulus money. We had the PPP money. We had the EIDL money. Now, what happened there? That's a perfect microcosm of what is potentially going to happen going forward, or which actually probably will happen going forward. So what we had is no money because the federal government it doesn't make anything. The economy is stagnant because we had shut down the economy. So we borrowed a bunch of money, right? The federal government borrowed a bunch of money. They borrowed money directly from the Federal Reserve. The Federal Reserve gave money directly to certain businesses and banks. We borrowed money we issued debt. Fortunately, interest rates were low, but we issued debt, and then we issued bonds, but we went into debt. We borrowed money and we went into debt, huge amounts of debt that we had to borrow and fund somehow, and that we're still borrowing and funding. And so what we did is we took that money, and the first thing that happened is we did the EIDL loans and the PPP loans. The PPP loans were the ones that are to be forgiven. They're the payroll protection program. And then the EIDL is the economic impact disaster loans. Those were the ones that were true loans. And so the PPPs went through the banks. The banks earned a ton of fees on these loans with no risk because they were backed by the government, right? So as long as you followed the rules, you were a bank and you followed the rules. That's why the banks were very, very conservative, especially those big banks. They followed the rules exactly. And that's why those big banks went to their largest customers first, because they knew the larger customers could follow the rules and were the safest, because it would be largely payroll. They wouldn't be dealing with a lot of things that were questionable, whether they were personal or business. They weren't be the owner's IRA account. The big companies took a lot of the question out, and they were one big number at the same time. And the banks earned fees on that. Now, they earned a fee for making that loan. You say, well, those fees weren't, but they also made a fee for selling those loans. So they're selling those loans. Again, these are investments. This is the government borrowing, and their government's guaranteeing these loans. So they had a 1% interest on it. Well, interest rate for a 2-year loan, 1% interest rate for a 2-year loan is fantastic. And if it's a government loan, if you could borrow treasury securities for 2 years at 1%, you're paying a huge premium for it. That huge premium was being paid on these PPP loans when the banks, particularly the big banks, turned around and sold them. And then they made additional money. As long as they don't get them back, they made additional money. So the banks made a ton of fee income off of the PPP program. They're not holding any of them. Some, they don't care. The government is going to pay them off, hopefully, but they made a tremendous amount of money. They sold these things out, made a tremendous amount of money. So now you've got the banks, especially the big banks, the money center banks have made a ton of money on this kind of loan. Now you got the EIDL loans. Those were directly from the SBA. So that's the government giving business money directly. Now, that money was so small that it was not allocated correctly. They actually capped it. So the program, when it was originally started, was a great program. And it was a loan program. So the government wasn't actually using up the money. They were actually going to get it paid back. So it was kind of a self-funding debt. So the government had to borrow money to make those EIDL loans, but they were lending it out. And as long as they got paid back, and these were 30-year fixed rate, as long as they got paid back, they were able to cover it. They were able to cover those loans. Now, if interest rates went up, on their side, and that's fixed on the EIDL, they were going to lose some money on the interest rate risk. But the bottom line was they were not going to lose money on those SBA loans because of the length of them, but they cut them way back. So the loans that were kind of self-funding and did less damage from a debt standpoint because they had to be paid back, they backed them off to the point that for most of the Main Street companies, it didn't even help them. I mean, the maximum was $150,000. It definitely didn't help the big companies, and so they just ignored it. But for the small companies, $150,000 was something they needed. And frankly, most of them needed more than that. They only got, and so it's one of these things where they can't get to it. Now, what happened is the government, kind of didn't spend it all. It still has some left to go. Who knows what's going to happen? But at this point, the government went big time into debt to make all these stimulus payments and to loan this money. They funneled it through the banks, except the EIDLs, which went directly from the SBA. Although, banks could have earned fees and people could earn fees off the EIDL loans. But anyway, what happened is that they went this route, and they used up this money, and now go to one of the big banks and try to borrow some money. I went to TD Bank the other day. I have a line of credit there, and they have effectively kind of an easy approval process. If it used to be if you were $100,000 and under, and I'm just picking on TD Bank because this happened to be the case. And TD Bank, I think, does a good job, but they're a big bank and they're protected, so they're going to do what they think is good for them. And they did a bunch of EIDL loans and PPP loans, and they made a bunch of money off of it. They did it to a lot of large clients and customers instead of the small ones. And they didn't do it to anybody who wasn't one of their customers, which, I understand. But the bottom line was they have this $100,000 line of credit thing, which is kind of a slimmed down version for small businesses to qualify without a lot of, audited financials or anything like that. So that was increased to $150,000. Now, previously, that line of credit was up to $100,000, but it was also capped off at 25% of your gross sales. So if you were $1 million worth of gross sales, which would be a very, very large business, local business, especially if it was a service business, a CPA firm, a law firm, a doctor, or whatever, a lot of them aren't individually generating $1 million in gross revenues. So let's say that you were, you were at that $500,000 level. Okay. So at that point, you're at 500,000, which is decent money. A lot of our small attorneys, law firms, CPA firms, all of those, would qualify. You're at 500,000. You're eligible for up to 125. They capped it at 100. All right. So now they're going to 150. So if they keep it at 25%, you could only go to 125, but that's still going to cover a lot of businesses. that are going to be able to get some extra money out of that. But what they did at the same time is they changed it so that now instead of 25% of sales, it has to be 15. It's only 15% of sales. So now to get the $150,000 line of credit, you have to have $1 million in sales. That is a completely different business than the small businesses that fund the economy. So what's happened there is, frankly, I understand TD Bank does not have to make any more loans. And if they make loans to small business, there's risk associated with it, particularly if they're not guaranteed by the government. So they've already got all these fees that they generated and all this income that they've generated. They've easily met their numbers for the year. And then they're getting funded besides through the government. The government's pumping money through them in the economy. So they don't need to do that. They don't need to make another loan to a small business that might go bad. So they've set new restrictions. These are their new COVID restrictions because they're worried that businesses won't survive. And who's not going to survive? Most likely, the small business is the one that's going to have the most trouble during COVID because they can't go that long. They don't have that much capital. They cannot go that long using their own internal capital. And now what did we do? We shut it off. So I don't care what the Keynesians say. Small business just got shut out of this lending because the federal government borrowed their money instead. And that is what happens. There is a limited supply of capital in the world. That's just the way it is. We fight against other people to get it. All right. If another country or our own government offers a better return with less risk, that's where the capital is going to go first. And then it's going to trickle down. And when it runs out, it runs out. And frankly, if it's been used to prop up businesses that aren't successful, that should have failed, like General Motors, or in the future, anybody else, it's used to prop up because we can't do without that business, which is just a politician saying, I can't do without those votes. That's where we got trouble. And so when the new administration comes in and Yellen, who was the chair of the Fed, is currently going to be running that ship, she is a Keynesian. She believes that we can spend an unlimited amount of money. So if you're a small business, you need to stockpile because it ain't going to be there coming up. I guarantee you. So pay attention to that. Keep an eye on that because that's going to be the biggest crisis coming up in the next 2 years is where you get money from because it isn't coming from the banks. Anyway, we'll talk more about this in the future because I think it's an issue that's going to be constantly with us for a while. But stay tuned every Wednesday morning from 9 to 10 o'clock here on WSTU. We talk about some things that affect you in your life right here on WSTU Digital 1450. We are Martin County's Heritage Station.